Do you want to grow your wealth over time? Welcome to the world of compounding, a simple yet powerful concept that can turn your financial dreams into reality. Picture a snowball rolling downhill. With each turn, it gathers more snow, growing bigger and bigger. Compounding works in a similar way. It's the process of earning interest on your interest, making your wealth grow exponentially over time. Imagine if you could turn a single rupee into 2, then 4, then 8, then 16, and so on. That's the power of compounding. And the beauty of it is, the longer you let your money grow, the larger your wealth becomes. Now that's a simple example, but when it comes to the real world, especially the financial world, compounding can be a game changer. So compounding can be your key to financial growth. But how does it work in the Indian stock market? Compounding works wonders in the Indian stock market, which has historically outperformed other asset classes. Now let's delve into the magic of compounding with a real-world example. Imagine you've invested 10,000 rupees in the Sensex index fund. Now what's the Sensex, you ask? It's a benchmark index that represents 30 of the largest and most liquid stocks on the Bombay Stock Exchange. Over the past 2 decades, the Sensex has returned an average of 15% per year. So let's say you've invested 10,000 rupees today, and the Sensex continues to deliver a 15% return annually for the next 20 years. With the power of compounding, your investment could grow to over 1 lakh rupees. That's right. You could see a 10-fold return on your initial investment in just 20 years, but that's not all. The beauty of compounding is that it's a snowball effect. As the snowball rolls downhill, it gathers more snow, increasing its size. Similarly, when you reinvest your earnings each year, your investment grows even larger. Now let's take the same scenario. You've invested 10,000 rupees in the Sensex index fund and it's yielding a 15% return annually. If you reinvest these earnings every year, your investment could grow to over 1,30,000 rupees in just 20 years. That's a 30% increase over your returns if you hadn't reinvested your earnings. The magic of compounding lies in its simplicity. It's about letting your money work for you over time. And in the Indian stock market, the power of compounding is not just a financial theory, it's a proven strategy for wealth creation. So let's summarize. Compounding is like a snowball rolling downhill, getting bigger and bigger as it goes. When you invest in the Indian stock market and reinvest your earnings, your wealth grows exponentially over time. In 20 years, your investment can grow to over Rs 1,000,000, and this is just the beginning. Reinvesting your earnings can boost your returns significantly. Let's dive deeper into this concept by taking a look at our Sensex index fund investment. Remember how we started with an investment of 10,000 rupees? Now what if, instead of merely sitting on our growing wealth, we decided to reinvest our earnings each year? Let's paint a picture of this scenario. Imagine that each year, we take the earnings from our Sensex investment and pour them back into the fund. We're not adding any extra money from our pocket, we're just using the money that our investment has generated for us. Now the magic begins. With each passing year, our investment isn't just growing, it's growing at an accelerated rate. Why? Because we're not just earning interest on our initial 10,000 rupees anymore. We're earning interest on our initial investment, plus the interest we've already earned. It's like a snowball rolling downhill, gathering speed and size as it goes. So where does this leave us after 20 years? With our initial investment and the power of compounding alone, we saw our 10,000 rupees grow to over 1 lakh rupees. But with reinvestment, our 10,000 rupees swells to over 1,30,000 rupees in the same time frame. That's right, reinvesting has given us an additional 30% return on our investment. This is the power of reinvesting your earnings. It's like adding fuel to the compounding fire, accelerating the growth of your wealth. And the best part? It doesn't require any additional investment on your part. All it requires is the discipline to reinvest your earnings and the patience to let compounding do its work. Remember, the Indian stock market is a marathon, not a sprint. The real winners are those who understand the power of compounding and reinvestment and use it to their advantage. That's a 30% increase over your returns if you hadn't reinvested your earnings. Impressive, right? So, how can you make compounding work for you in the Indian stock market? One of the secrets lies in starting early. The earlier you begin your investment journey, the more time you give your money to grow. It's like planting a seed and giving it ample time to grow into a towering tree. Next, it's about investing regularly. It doesn't matter if you can only afford a small amount each month. Over time, these small amounts add up, just like drops of water forming an ocean. The key here is consistency. By regularly investing, you allow your money to snowball, growing bigger and bigger over time. Then there's the power of reinvesting your earnings. When you reinvest your earnings, you're essentially putting your money to work for you. Your earnings generate their own earnings, leading to a snowball effect. It's like a train gaining momentum, picking up speed as it goes along. This is where the true magic of compounding comes into play. Lastly, it's crucial to diversify your portfolio. As the saying goes, don't put all your eggs in one basket. By spreading your investments across different sectors and asset classes, you reduce your risk and increase your chances of earning returns. Just like a well-balanced diet is essential for good health, a well-diversified portfolio is key to healthy investments. Let's illustrate this with an example. Say you've invested in HDFC Bank, one of India's largest and most profitable banks. You've also invested in Infosys, a global leader in the IT industry, and Reliance Industries, a diversified conglomerate with interests in various sectors. If one of these companies faces a downturn, your other investments can help balance out the losses. So there you have it, the recipe for making compounding work for you in the Indian stock market. Start early, invest regularly, reinvest your earnings, and diversify your portfolio. These are the ingredients for a successful investment journey. Remember, the key to compounding is patience and consistency. By sticking to these principles, you too can make the most of the power of compounding and grow your wealth in the Indian stock market. Now, let's look at some Indian stocks that have compounded investors' wealth over the long term. First up, we have HDFC Bank. This financial titan is one of the largest and most profitable banks in India. Not only has it consistently shown strong earnings growth, but it has also paid out regular dividends to its shareholders. This combination of capital appreciation and income has allowed investors to compound their wealth significantly over time. Next, we turn our attention to Infosys. This leading Indian IT company has been a major beneficiary of the global IT industry's growth, consistently delivering strong earnings growth. Investors who have held on to their Infosys shares have seen their investments grow exponentially thanks to the magic of compounding. Finally, let's talk about Reliance Industries. This diversified conglomerate has interests in a wide array of sectors, including oil and gas, petrochemicals, retail, and telecom. The company's innovative approach and solid execution have resulted in a robust track record. Investors who reinvested their earnings from Reliance Industries have seen their wealth multiply, once again highlighting the power of compounding. These companies have not only been successful in their respective industries, but they have also rewarded their investors handsomely. The key takeaway here is that these companies' consistent earnings growth and their investors' discipline to reinvest those earnings have resulted in substantial wealth creation. This is the essence of compounding. It's worth noting that while these companies have been successful, investing in the stock market always carries risk. It's essential to conduct your own research and consider your financial goals and risk tolerance before investing. Diversification across different sectors and asset classes can also help manage risk. These companies are prime examples of the power of compounding in the Indian stock market. So we've learned that compounding is a powerful tool for growing your wealth. It's like a snowball effect, where your earnings generate even more earnings over time. This is especially true in the Indian stock market, which has consistently outperformed other asset classes. We've seen how investing early and regularly and reinvesting your earnings can significantly enhance your returns. Remember the Sensex example? An initial investment of 10,000 rupees could grow to over 1 lakh rupees in 20 years, thanks to the power of compounding and a consistent 15% annual return. We've also seen how diversifying your investment across different sectors and asset classes can reduce risk and enhance returns. Companies like HDFC Bank, Infosys, and Reliance Industries are great examples of stocks that have historically delivered strong returns and compounded investors' wealth over the long term. With patience, regular investments, and a diversified portfolio, you can harness the power of compounding to achieve your financial goals.